Want to pay less in taxes? With smart planning, you can pay $48,436 less in taxes in 2025 by taking advantage of retirement accounts, tax credits, and tax deductions. Here's exactly how you're going to do this. The first thing you can do is contribute $23,500 into a traditional 401k. This is the maximum amount you can contribute in 2025 if you're under the age of 50. A 401k is a special type of investment account for retirement that is set up by your employer. While you won't be able to withdraw money until age 59 and a half, the money put into a traditional 401k reduces your taxable income. If you make $100,000 and contribute the full $23,500, your taxable income drops to $76,500. In the 22% tax bracket, this would save you $5,170 in taxes. The next thing you can do is contribute $7,000 into a traditional IRA. That is the maximum that you can contribute in 2025 if you are under the age of 50. IRA stands for Individual Retirement Account. It works similarly to a 401k, except anyone can open one up. It is not set up by an employer. The money put into a traditional IRA directly reduces your taxable income. In the 22% tax bracket, this would save you $1,540 in taxes if you make the maximum contribution. The third thing you can do is contribute $4,300 to an HSA. HSA stands for Health Savings Account. It is a special type of investment account used to pay for health expenses, but can also be used to save for retirement. Unfortunately, not everyone is eligible for an HSA. To be able to contribute to an HSA in 2025, you need to have health insurance that has a deductible greater than $1,650. A deductible is the amount of money you have to pay before your insurance kicks in. The money put into an HSA directly reduces your taxable income. In the 22% tax bracket, this would save you $946 in taxes if you make the maximum contribution. If you were to max out your 401k, IRA, and HSA, the total tax savings so far is $7,656. Next, let's talk about the standard deduction. This is a set amount of money that the government lets you subtract from your income before calculating how much tax you owe. In 2025, you get to reduce your taxable income by $15,000 if you decide to take the standard deduction. In the 22% tax bracket, this would save you $3,300 in taxes. This brings our total tax savings so far in this video to $10,956. However, some people might benefit more from taking an itemized deduction instead. An itemized deduction is where you list specific eligible expenses you've had during the year and subtract them from your income to lower your taxable income. The most commonly itemized expenses include interest paid on mortgages up to $750,000, state and local income, sales, and property taxes up to $10,000, and unreimbursed medical expenses that exceeded 7.5% of your income. You can either take the standard deduction or itemize your deductions. You cannot do both. So, you should only itemize your deductions if the list of expenses is greater than the $15,000 standard deduction. Let's move on to tax credits next. A tax credit is an amount of money that directly reduces the amount of tax you owe instead of reducing your taxable income. In other words, a $1,000 tax credit saves you $1,000 in taxes. There are several different types of tax credits. These change every year, so make sure that you are staying up to date on them. The tax credits in this video are for 2025. If you're a parent or caretaker, there are 3 tax credits you might qualify for. The child tax credit provides up to $2,000 per qualifying child under age 17. The adoption credit offers up to $17,280 in tax credits for qualified adoption expenses per child. The Child and Dependent Care Credit assists with expenses for the care of children under 13 or dependents, up to $3,000. If you pay for higher education, there are 2 tax credits you might qualify for. The Lifetime Learning Credit provides a tax credit of 20% of qualified education expenses up to a maximum of $2,000 per tax return. The American Opportunity Tax Credit offers a tax credit of up to $2,500 per eligible student for the first 4 years of post-secondary education. If you invest in clean vehicles or clean home energy, there are 2 tax credits you might qualify for. The Electric Vehicle Tax Credit provides a credit of up to $7,500 for qualifying new electric vehicle purchases. The energy efficient home improvement credit offers a credit equal to 30% of qualified energy efficient improvements with an annual limit of $3,200. Adding up all of these credits, this brings the total tax savings in this video to $48,436. If you found this video helpful, subscribe to our channel for more videos to maximize your money and build wealth. Also, you won't want to miss our video that teaches 30 years of personal finance knowledge in under 30 minutes. This is the video that shares everything I know about investing, saving, and taxes that helped me build $1 million in net worth before age 30. Click on that video here or find the link in the video description below.